the ultimate concept that has to be present in order for you to have control over another entity and be a parent. Okay, so that's very important. Provides guidance on how to interpret or apply control. Now, ladies and gentlemen, that's important. We're going to look at some examples, but I'm just going to show you the approach that you need to follow. We cannot look at every possible example because that would take us a week to do. So what you need to do is to establish an approach in considering control, and that's the important thing to do. Then sets out the accounting requirements for the preparation of consolidated financial statements, and here I'm going to look at things like IAS 27 paragraph 30, IAS 27 paragraph 34, things that we've spoken about, all right? All of those areas where they explain consolidation, the consolidation process, those areas have basically been retained from IAS 27 and just put into the new IFRS 10. So that will not be the primary focus of this lecture. The primary focus is to help you to understand the new concept of control. All right, IAS 27 now only deals with separate financial statements of the parent. And you can see there at the bottom of slide 9, individual financial statements versus separate financial statements. What's the difference? Ladies and gentlemen, when you have an investor that has, let's say, joint control over a joint venture or any joint arrangement, and you have, for example, an associate, all right, so you are also the investor, but this time you're the investor in an associate, so you've only got significant influence over the associate. You are not in a group situation. So you're not going to be preparing group or consolidated financial statements because there is an absence of ultimate control. Do you agree? Yes, there's joint control, but that is not ultimate control for this one company that we're looking at. Such a company, when dealing with its own transactions and dealing with the investment in the associate and the investment in the joint venture, will be preparing individual financial statements. Now, this is much more important than you think. Because what's important, IAS 27 deals with separate financial statements. Not individual, but separate financial statements. So what's important? There has to be a difference between the two. Now, if we move on and we say there's a parent company that holds an investment in a subsidiary, okay? That parent company is going to prepare separate financial statements because those basically preempt the consolidated or group financial statements. So that's very important to know. And I think we discussed this in the lecture on IAS 27 as well, but there's a short revision for you as well. So what is your test? If you want to go apply the principles of IAS 27 and talk about separate financial statements, you must make sure that there is a subsidiary somewhere present in the group that is going to be consolidated, because the next step after separate financial statements will be the preparation of the consolidated financial statements. So what am I saying here? Only a parent that has ultimate control in terms of IAS 27 and now IFRS 10, control in terms of IFRS 10, will be preparing separate financial statements that basically go before the consolidated financial statements. All right, and that is why these principles are contained in IAS 27 dealing with separate financial statements. Okay, so I hope that difference is clear to you. So I'm just going to say it once more regarding the individual financial statements. If you are an investor, you can hear I'm not using the word parent. If you are an investor with an interest in an associate or in a joint venture or a joint operation for that matter, okay, and you don't have a subsidiary, then when you deal with the associate and you deal with the joint venture in your own financial statements, we call that individual financial statements. All right. Okay, ladies and gentlemen, let's move on. Slide number 10. To conclude this chapter, the entities likely to be affected by the release of IFRS 10. So basically, why this slide? To open up your eyes as to where IFRS 10 is going to play a role. Let's have a look. Owners with less than 50% ownership. In the past, it was very easy to determine, okay, because control had a very narrow definition. But now, what if you own less than 50% of the share capital, or look at the second bullet point, owners with less than 50% of the voting rights? Is it possible for those entities to still have control over another entity? And the answer is yes. Because control, for example, can be established by contractual arrangement with those shareholders. Okay? So then voting rights are not the only indicators of control. Now, what is important? That is what we call de facto control. D-E-F-A-C-T-O. De facto control. All right? And that is when you control an entity with less than 50% of the ownership or the voting rights. So that means there's something special. Think about the concept of potential voting rights. We spoke about that in IAS 27, but what is important now? Potential voting rights are applied slightly differently by IFRS 10, and we need to just bring your attention to that. The third bullet says holders of potential voting rights. We'll talk about that. Entities to which power has been delegated. So that means delegated control. Is that okay? What can I delegate control to someone? And typically, if you look at the last bullet on the slide, you look at your agent versus principal relationships. Okay, so the question is, can an agent gain control over a company if control has been delegated to that agent? All right, so IFRS 10 also looks at that. And then the second last one, what do we do in the case of special purpose entities? And by the way, you must just now realize special purpose entities are now called structured entities. We don't refer to them as SPEs anymore. They are called structured entities. Where do they fit into the new picture of IFRS 10? Now, the good news to conclude this chapter is that we now have one definition. We don't have to worry about, is it a subsidiary, is it a structured entity, whatever it is, it a trust, etc. We have one definition, one set of rules, but in IFRS 10, the one thing that you should note is that there's a lot of professional judgment required. And now the nice thing, well, not for some people, but, there's a disclosure requirement that has been brought about by IFRS 12. Where all of these assumptions that you are making in terms of your professional judgment must be disclosed in the financial statements. All right, so we'll get to IFRS 12 in the lecture on IFRS 12, but just take note of the disclosure requirements relating to your professional judgment. So you can see this is an interesting topic. We're going to enjoy exploring it further from the next chapter. In Chapter 2, we're now going to look at the definitions contained in IFRS 10. And this is very important. This is your starting point in understanding IFRS 10. Let's move on to slide number 12 and have a look at the key definitions contained within IFRS 10. The first one, consolidated financial statements. Now, that is the obvious one because that's also the name of the standard. Do you agree? So the financial statements of a group, you see the word group, very important, in which the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries are presented as those of a single economic entity. What's important? Group financial statements, that doesn't become a separate entity. It doesn't have a tax status. It doesn't do transactions as a group. That's purely put together on paper for reporting purposes. Do you agree? And that's why in your consolidated financial statements, you don't process actual journal entries because this is not an actual entity that exists. You process pro forma journal entries. So when you get asked to prepare pro forma journal entries, and you get asked that very often, especially in QE Part 1 and also in your CTA here, dealing with group statement questions. All right? You will have to process those pro forma journal entries in the consolidated or the group financial statements. Now, what's important about this definition? If you do not have a parent with at least one subsidiary, you do not have a group, you do not have consolidated financial statements. And that's what we spoke about in Chapter 1. Do you agree? So I don't want to repeat all of that information. All that you need to see is, without a subsidiary, we do not have a group. We cannot prepare consolidated financial statements. And once again, what makes something a subsidiary? The fact that the parent controls that entity. All right, let's move on to slide number 13. Control of an investee. Now, ladies and gentlemen, this is the ultimate definition. What is the new definition on control? Let's have a look. The previous definition was that control is the power to govern. Can you see govern? So you basically just needed power instruments. Because how do you govern? You govern through voting rights. You govern through decision making. Do you agree? So if you could make decisions, you had control. That's how limited the definition of IS 27 was before. But what's the important thing now? The power to govern the operating and financial policy decisions of another entity. That's the old one. So let's compare it to what's important now. Let's look. The new definition is that an investor, okay, that would become a parent, obviously, controls an investee when the investor is exposed to or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. So what can we see here? There's more evidence of SIC 12 in this definition. You see, because that whole concept of, can you remember SIC 12? You control the entity for the purpose of gaining benefit from its activities. Can you remember? That was the previous SIC 12 definition. So the benefit from activities. Now, what have they done here? They've replaced the word benefit with returns, because benefit sounded like it was only positive. Do you agree? And the word returns, that means that it can be negative or positive. Very important. Okay? So what's important here? Let's have a look at the definition again. The exposure. And the part that's highlighted here in bold and in red, you can see there, exposed to or has rights to variable returns. Now, ladies and gentlemen, look at this in its simplest form. Variable returns. What does that mean? The profit of the company is variable. Do you agree? Because it's not fixed on an annual basis. And depending on how the company is managed, that will determine the ultimate profit. Do you agree? So it's a variable profit, and it can also be a loss at the end of the year. So that's why we have this exposure to variable returns. So now the question is, what is our exposure? How do we gain this exposure? Because we are shareholders, do you agree? Or owners, like we call shareholders these days, but also through your dividends. Think about it in a simple form. The better the company performs, the higher the dividends. The worse the company performs, the lower the dividends. Do you agree? So that's the exposure to the variable returns. There must be that exposure. All right? Because in the end, you can see all of these things stick together. Now, on its own, it's not going to mean anything. Let's read the rest of its definition. From its involvement with the investee, and I would circle that word and, because all of these components must be present in the definition of control, and has the ability to affect those returns through its power over the investee. So can you see the next concept that you have to investigate? The ability to affect the returns. Now that's the portion that specifically sounds very familiar to what was in SIC 12. So now you must now say, all right, the returns are variable. I must firstly prove that. I'm not earning fixed remuneration or something like that. Okay? Then, for example, think about a preference share, 10% every year. Does that depend on the profit? No, it doesn't. You get your 10% preference dividend regardless. Do you agree? So the question is there control? No, because there's no ultimate exposure to variable returns. So we're looking here at our ordinary shareholders. They will be in the typical position of exposure to the variable returns. Now, the next thing, the ability to affect those returns. If you cannot play any role in the outcome of the eventual return, for example, the decisions that you can make in this company have no real bearing on how the profit eventually, materializes for this company, then there's no control over the company, all right? Because you need to go ask yourself, what can I actually affect? And that's why it's so important to look at the activities of the company that you think you control. And we call those activities the relevant activities. So the next step, after you've proven now that you are exposed to variable returns, or you have rights to those variable returns, like a shareholder, the next thing